So let's begin here. Chapter 1, an introduction to tax. I'm going to take you through the chapter and just outline some of the things that are important, and then we'll move to using Intuit's product. It's called ProConnect. It's an online tax package. It should give you a good idea of kind of what this means on a realistic level as far as producing a tax return, etc. So for now, we'll just leave this up. So this is for the tax year 2022, although, our publication is, for the textbook, is 2023. So if you pull out your book to chapter 1, you can kind of skip this first storyline summary. Just kind of weird, probably not realistic, and honestly, let's just move past it to who cares about taxes and why. The story was just setting that up. Let's move into it. You can go ahead and skim down through to right above where it says the role of taxes. So you have the bullet points down there. The end of the paragraph right there, it says other common personal financial decisions that taxes influence include choosing investments, evaluating alternative job offers, savings for education, expenses, and performing gift or estate planning. Indeed, taxes are a part of everyday life and have a significant effect on many of the personal financial decisions all of us face. The role of taxes is not limited to personal finance. Taxes play an equally important role in fundamental business decisions such as the following. Now, I'm not going to show the textbooks. Hopefully you have it up. I'm not sure we can get away with copyright laws on throwing it up on YouTube, so I'm going to leave ProConnect up for now. You can kind of read through this. It should make logical sense to you when you think about it. I think as an example, as a deeper understanding, if you go to number 2 where it says, where should a business be located? At first glance, some of these may not seem important, but if you think about the idea that Bezos originally started Amazon in Washington, the sole reason was because he had so few buyers in that state, which meant that he would have to pay the least amount of sales tax. So definitely there's some real issues as far as where you would start your business. For a small business, I have a client. He started a pizza company, extremely successful. And you think, well, for a small business, we would just, look at your local market. But he literally got in his car and he visited every major university in the United States to try to get an idea of what the situation was, the demand for pizza, the supply of pizza, and it made all the difference to his future success. You can skim through taxes in the real world. I think anyone reading a newspaper gets the idea that Republicans and Democrats, there's no real agenda here. They're just pushing their agenda and would beyond silly. We just will move past that and not pretend that there's any real objectionable goals to try to help everybody. But we do begin that next paragraph after that. In summary, taxes affect many aspects of personal, business, and political decisions, which is incredibly true. What qualifies as a tax? So it says here, a tax is a payment required by a government. I think we can just stop there. It goes on to say unrelated to a specific benefit or service received from the government. The idea here is that it's just a general tax. You pay the taxes, the government decides what to do with it. I think for the most part, we know what the money will be paid for. So I think the definition is kind of problematic. Go down to the bullet points, the key components. It's required. It's imposed by the government. It's not tied directly. So legally, it's not saying directly like your dollar will buy this bridge. But pretty much the stability of this amount of money goes for education, this amount of money is going for military, this amount of money is going for da 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 da. And we kind of know what it's going for. So we can scroll down the next section, how to calculate a tax. I think most people should be pretty familiar with the idea. The tax is equal to the tax base times the tax rate. They've done a great job in this chapter. I think you can pretty much assume anything in bold you should read twice. They give you an example here, but I think it's pretty much obvious. I mean, I think anyone who's bought anything has an idea that take your $1.80, that's your tax when you have a $30 purchase and there's 6% tax. This next section here where it begins different portions of a tax base, very, very important. Read this a few times, put a check mark by it. It says different positions of a tax base may be taxed at different rates. A single tax applied to an entire base constitutes a flat tax. In the case of graduated taxes, the base is divided into a series of monetary amounts or brackets, and each successful bracket is taxed at a different, gradually higher or gradually lower percentage rate. So we will move down to where different ways to measure tax rate. Another checkbox moment. Before we discuss the alternative tax rate structure, let's first define 3 different rates that will be useful in contrasting the different tax rate structures: the marginal, the average, the effective tax rate. So this is probably one thing you should understand completely. You will have a great deal of questions about this. It is completely misunderstood. People don't understand. People don't get it. That equation 1-2, it makes it a little more complicated. It is if we just move down to the next page where it has married filing jointly. So you see if you go to that third line, over 83, but not over 175. So if you look at this, what's going on here is, here, maybe let me pull that up for you here. I think we should be allowed to show that. So in this section here, this is how the tax rates are set up. So when you pay federal income tax, and the state tax system pretty much mirrors it, but at smaller rates. So if you make $20,000, so if you make from $0 to $20,000, you pay 10%. So $20,000 in income, take the 10%, multiply it out, that's what you pay. If you make over $20,550, this again, remember, this is for someone who's couple, married, over $20,550, but not over $83,550, you pay $2,055. So that's easy to see. It's 10%. So it's 10% of the $20,550. So that's done. Once you get up to that 20, you pay that 10%. The amount is $2,055. Now, your next marginal rate is 12%. So now for every dollar over 20,000, so every dollar over 20,550, you're paying 12%. So that next dollar, the 20,551, that $1 you're paying 12 cents on. Whereas all the money before you paid 10 cents. So, and then it goes every dollar you make up until the next 83,550, you're paying 12%. Now, if you make over 83,550, now you pay 22%. So this is good to pause at this point. So you move from 10% to 12%, 20% increase. Not a big deal. Now we're moving into the next bracket, 22%. So when you move, so for every single dollar you're now making over 83,550, that amount is now being taxed at 22%. So not quite double, but almost double the amount of money. As you see, as you move into the next tax bracket, it's double. Clearly double than the initial tax bracket of 10%. Now remember too, this isn't all your income. This is your taxable income. So you you say you made $100,000, but you had $30,000 in expenses that you were able to deduct from it. And then, so you had 100,000, 30,000 expenses, your taxable income is just 70. So 70 is still putting you in a first bracket there, or the second bracket, the 20 to the 83. So these are the marginal rates, 12%, 22%, 24%. They're marginal rates. It's the tax rate of the amounts in between. So that should actually should make pretty good sense, really, when you think about it, but it is essential you understand what's going on here. So I'll show some examples here in a minute, but we're gonna scoot right along till you get to tax rate structures. There are three basic tax rate structures used to determine a tax: proportional, progressive, and regressive. Again, we're kind of on the same subject. If you read the news at all, you should have kind of an idea. Proportional tax rate structure, also known as a flat tax, imposes a constant tax rate through a tax base. So basically it's saying it's one rate all the way through. So no matter, sales tax is kind of like this. So no matter what it is, it's just a flat tax. On the example before, it'd be like that 10% was just all the way through the income. It was just flat. Progressive, that's the income tax that we just showed. The progressive tax structure imposes an increasing marginal tax rate as tax rates increase. The graphics maybe help you, maybe not. I think it's easier just to think of that original graph that we just saw. So as a flat tax, all those rates would be exactly the same. As a marginal rate, that's exactly what is in that diagram. And then if we move to the regressive tax, it would be, you would flip that upside down, so it would be higher, and then it would go down and down and down. The graph in the books makes perfect sense, but I think if you're new to the subject, you might look at it and think, So we go down to types of tax, federal tax system. So we have that first paragraph, read that whole paragraph, and then the next section, income tax. As you see, it represents about 50.2% of all tax revenue collected in the United States in fiscal year 2021. Most people are familiar with the income tax is. You have unemployment and employment taxes. So these are Social Security, Medicare taxes. If you've ever had a job, you'll see those on there. You won't see the unemployment tax because the employer pays all that. Excise taxes, you're familiar with that. You see that in the price of gas you pay. You see it in the battery tax you pay, tire taxes, those kind of things. Transfer taxes. So your dad dies. He has currently needs to be over $10 million. A little, it's actually more than that, but roughly it's $10 million. So dad dies. He has $20 million. You're going to have to pay a transfer tax on that amount over $10 million. The states have the same type thing. So you go down into the next section. It talks about how the state taxes, and it show, on the example, sales tax makes up about half, and then individual income tax. And then there's several states that don't have income tax. Florida doesn't have income tax, primarily because there's so much tourism that they can collect it from a tourism tax and sales tax. Property taxes. State and local governments commonly use two types of property taxes as sources of revenue. Real property taxes and personal property taxes. Both are ad valorem taxes. So you're probably very familiar. You own a house. Every year you pay real estate taxes, but many businesses, they pay tax on the property that they own. So if you're a physician, you buy an MRI machine or an ultrasound machine or what have you, every year you will pay a tax just to have that equipment in your business, property tax. So let's move on down through the rest of the chapter. I think you can just kind of skim most of that. You get down to equity. So again, we're back to that section where they're talking about, the Republicans versus Democrats. You can look at, what's equity, what's fair. Horizontal equity means me and the person next to me, same income, same house, same area we live in, yada, 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 you're paying about the same amount of tax. So vertical equity is how people that make more than us and people that make less than us, how are they treated according to taxes? Certainty means that taxpayers should be able to determine when to pay the tax, where to pay the tax, and how to determine the tax. Convenient suggests that a tax system should be designed to facilitate the collection of tax revenues without undue hardship on the taxpayer or the government. Economy requires that a good tax system should minimize the compliance and administrative cost associated with the tax system. So the book kind of gives the idea that our Federal Internal Revenue Service is doing a good job. I can say that for sure. They are doing a poor job. They're doing a poor job of collecting a tax. They are months and months behind. They have people that are getting refunds like a year later. They're not answering letters timely. They are not picking up the phones. They are they're a disaster currently. So hopefully this $80 billion that they're getting will have a help, but it doesn't look like enough is being spent on modernizing this system. So the way the IRS works is, if you envision, it's kind of like your bank account, and then every person has a bank account for every year. So it'd be like if you opened up a bank account for this year, a bank account for next year, a bank account for the following year, and you kept track of all your money with a system you created in 1970. That pretty much gives you an idea of kind of what they're working with. And it just creates a great deal of problems. All right, so let's go in here and start this return. So go in here, client information, Florida. They are married filing joint. His name is Bill. Last name is Bill Johns. There's his social security number. He is a fireman. His wife is Mercedes. Hers, and she is a teacher. She was born the day after him. And this is where they live. Their telephone numbers. This is to authenticate them. There we go. So we're going to go in here and go to their income, their wages, and he worked for Winn-Dixie. And the book said he made how much? So the book had him at 160,000. Let's give him 190,000 and $25,000 withheld. So this is the federal income tax withheld. This is what they paid in on their W-2 in advance. This is the Social Security wages, which they paid $9,114 in tax. The employer matched that, and so paid $18,000 into the government. They had $2,755 withheld from their wages. the employer again matched that and paid that into the government. So here's some different types of taxes, federal taxes, but this is just a prepayment. It's not the actual tax. This is the actual tax. It's the payment for it, but here's all the different things that can come out. So let's go ahead and here's our tax return. They started out with $190. They had deductions at $28,700. It's just a standard deduction. So we can see here their taxable income is $161,300. So it's a $1,300 more than the book. We scroll down. This is what they paid in, $25,000. This was the total tax, $26,720. So as we saw before in the book, this is the tax based on that schedule. Not the schedule in the book, but the actual schedule for 2022 married filing joint. And and that means that at the bottom you take the 25 they paid in plus the 26. So they still owe $1,720. Now, so that wraps up the first example. You can use that to get an idea to go through the example and see how it looks for real. And then let's do one more thing in here. Go to rental and royalty income. We'll leave this alone for now. The spouse. Rents or royalties received. Refresh. So they had 190. Those are from the W-2s. And as you can see, they have some other income, $80,000. Whoops, hold on. We had to go back to this form, and here you select what type of property it is. So royalties, refresh. Go back to there. So now it's on the royalty line. You can see it falls through here. We have some extra forms. This is where the royalty flows to from that Schedule E. We'll get to this later. Go back to here, and as you see, so now they have this additional $80,000 in royalty that now has brought them up to $45,000 in taxes. They didn't pay any more because royalty is just a check, and but they owed 46. They paid in this 25. Now they have to write a check for 21,343. So let's go back. Say for whatever reason they spent $160,000 to make this book that year. This was to, and then we'll hit refresh. Now they had the $190,000 in income. They lost $80,000. Brought their taxable income to $81,000. Now they pay a tax of $9,000. They paid in $25,000. They're getting $15,652 back. So, in relationship to the book, I think gives you an idea of how the taxes work on a scaled system. And I think these wages here, if you look at it, you can see how we have federal income taxes, that's really this number here. This is what you paid in, but this is the tax. And then you have this Social Security tax. This is the employee half Medicare tax, employee half. So double that. That's how much is getting paid in for Social Security Medicare taxes. And if you want to verify these amounts, this is taken from Forbes.com for 2022, married filing separately. Oops. Single, married filing separately, had a household, and married filing joint tax bracket. So this is the bracket you can calculate that example on and see if you can calculate it manually and see if it's correct, and maybe even do it and see if it's off by $5 or $10. All right, thanks.